Now I'll make a separate video for buying puts as well as selling calls and selling puts, but today we're going to be focusing on buying calls. Now remember, before you ever enter any options trade, please make sure you know how to close it. I'll pin a video in the comment section below where I show you guys how to close out of any options trade. Now this is something that I've never talked about before because I actually just learned this myself, and so I figured I would share this with you guys in hopes that it might help you out when you're down on your call option. Now, our goal here today is going to be to try and recover from a bad long call trade, and this will actually benefit us in two different ways, and I'll talk about those two different ways here in a second. But one thing I do want to mention here right now, guys, is that this isn't really going to work if you're already down, over 70%, I would say. It could work, but it's very unlikely because your option has already lost so much of its value already. So when you're down, 70, 80, 90%, this is a lot harder to actually use to recover. So just keep that in mind. But, if you're down 30, 40%, this could be something you try here. So what you want to first do here is you want to go over to a stock that you bought a call on, and now you're down on that call a bit, right? So again, 10, 20, 30, 40%. And so I don't actually have any calls that I've bought right now. So I'm just going to go ahead and just choose an example here and show you guys how this would work. So I'm actually going to go over to SPY because SPY is down quite a bit today. And so we'll just pretend that I had bought a call last Friday, and today I'm down quite a bit on that call that I bought. Now remember, when you buy calls, always check commission fees because some brokers have high commission fees that could eat away at a lot of your profit. Robinhood doesn't have any commission fees, so we don't have to worry about that on here. The other thing, remember guys, when you buy options, there is no risk of assignment. You only can get assigned when you sell options. When you buy a call, there is no risk of that. So let's go into the options here for SPY. And so let's go to the calls. So we're already on calls. And again, we're focusing on buying calls here today and recovering from them. So number one, you do not need 100 shares to buy a call. You do not need to have enough money to potentially buy 100 shares when you buy a call. When you buy a call, all you need is to have enough money to purchase the actual contract, and that's shown under the price column here, okay? So let's go ahead and let's go out to April 29th. So again, let's pretend I bought a call last Friday for this expiring April 29th, so this Friday. And so as you can see, I would be down quite a bit had I bought a call on Friday. And so what's nice here is that we can see what the price of the call option is, but we can also see how much it's changed today, right? If you take a look here in change, this tells you how much the value of this contract changed today. So for example, this call option right here is actually down 360 today. In other words, if you would have bought this call on Friday at the end of the market when it closed, right now you'd be down $360 or about 42.24%, right? So since we can see this, we can actually make it pretty realistic here in terms of how much we would have purchased our call on Friday. So let's go ahead and let's focus on, I want to focus on the call option at the $421 strike. So let's say we had bought this call last Friday around when the market was about to close. Again, if I would have bought this call and I'm still holding right now, I would be down around $370 or about 40%. So here's what I'm going to do. I'm going to go over to Option Strat, and I'm going to go ahead and take a look visually at what this would look like right now. Okay, so let's go over to a new tab here, and we're going to go to Option Strat. Let's go to Build, and let's go to Long Call here. So again, we are using SPY. So SPY, we are saying, okay, we bought a call expiring April 29th. So this Friday, we bought our call at the $421 strike, but we didn't buy it right now. We bought it last Friday, right? So now we're down quite a bit on it. So let's say that we paid about $804 for this call option, right? So $804. So we'll see a couple of interesting things here, right? So we'll see that we paid $804 to enter this trade, which is also your max loss, right? Whatever you pay, that's the most you can lose. Max profit is infinite, which makes sense. And then we have our break even here as well. And then we have an unrealized loss of $269, right? So if I bought this call last Friday for 804 and I'm holding right now, I'm currently down $269 or 33%. So again, what I want to focus on here now is how can we try and recover from this? And there's a way to do this where, again, it's going to benefit us in two different ways here. So basically what we're going to end up doing here is we're going to repair this long call option here by rolling to a debit call spread. So here's what we would do. So I'm going to go to a new tab in Option Strat, and I'm going to go to Build, and I'm going to go and set up the exact same long call so that we can compare these two strategies here. So again, we're using SPY, so ticker symbol SPY. And then we said, okay, we bought the call at the $421 strike expiring April 29th, but we bought this last Friday. So let's say we would have paid around 804 or so. And so right now we're down, 277. And so here's what we want to do here. And again, keep in mind, this is not always going to work, especially if you're already down 70, 80, 90% on your call option. But what you would do is you would first start by closing out of this position. And so remember, the way you close out of a position is you enter the exact same opposite trade. So if I bought a call at the $421 strike expiring on April 29th, now I'm going to sell that exact same call. So same strike, 421, same type, it should be a call, same expiration, April 29th. So I'm going to come in here and do add, and I'm going to sell the call at the $421 strike. Okay, and so basically you're going to be taking a $277 loss. Now what you're going to do is you're going to buy another, or you're going to sell another call at the exact same strike, so 421. So now I'm selling two calls at the $421 strike. So far we are getting a $250 credit, but we have a max loss of infinite, right? Because we're selling a call, but we don't have 100 shares. We're not buying a call against it. And then we have our max profit. So now what we need to do is we need to buy a call so that we're actually able to sell this other call here. So what we're going to do is we're going to go to add, and we're going to go to buy call. We're going to buy a call option now with a lower strike than the call that we are selling, which is at the 421. So I want to buy a call now with a strike less than 421. Now this is the important part here. You want to buy a call here where you're actually still gonna get, or you can actually still see a max profit. Because notice for this one, for example, if I buy this call, there is no max profit here. This is telling me that no matter what, I'm gonna lose $182. So you want to keep going down until you actually see a max profit again. So I'm gonna go down and down and down, down, and there we go. So now I have a, so now as you can see, there's a max profit again of $14 here, right? So that means that I actually am able to potentially actually make money here and not actually have to lock in a loss here. So now that we've done that, this is basically what we did, right? Remember, we had bought our call, but we were down on it. So we closed it by selling a call. Then we sold another call at the exact same strike. And then we bought a call with a lower strike where we can still make a profit. And so basically what we did, like I mentioned, is we had our long call and now we rolled it into a debit call spread, which is still a bullish strategy, by the way. But now take a look here, okay? There are two main benefits that we see here now by doing this. And we're going to compare both of these. So let's go over to, so let me refresh this to get the latest data. And then let me go back here and let me refresh this to get the latest data. So here's what I see, okay? So here's the call we bought. So remember, we paid 804, so our max loss is 804. That's the most we can lose. Well, now take a look over here at our max loss, 688. So by doing this, we actually just reduced our risk because now our max loss is less. It went from 804 to 688. Okay, so we just dropped the amount that we could potentially lose, which is nice, right? That is a benefit here. The other benefit, though, and what makes this very powerful in my opinion, is the break even now. So remember over here, when we bought our call option, our break even is 429.04 or plus 2.4%. So SPY needs to get up to 429 by our expiration just for us to break even here. But now let's take a look at this this debit spread, this call debit spread that we just rolled into. What's our break even here? 420.88 plus 0.5%. So look at our break even. It dropped considerably because now instead of SPY having to go up to 429, it actually can just trade sideways pretty much here and we'll actually still make money, right? Because if we take a look here, right, if SPY just trades sideways and just moves up a little bit here, we can actually still leave with a $12 profit. Remember, if we look at the call we bought, if we would have just bought our call and it just trades sideways, what's going to happen? You're going to lose all your money, right? So now we see two benefits, right? Not only did our max loss drop, our max loss is less potentially here, but now our break even is also less. So SPY doesn't have to go up as much anymore for us to break even here. It only has to go up to 420.80 versus going up to 429. And again, this isn't always going to work, especially if you're already down, 70, 80, 90%. But, if you're looking to not only, reduce your risk by bringing down your max loss, but also potentially, you don't think the stock's going to move as high anymore, this allows you to bring down your break even. Again, our break even now is down to 420.88. Now let's see if I move it more down here, what's going to happen. So here now, as you can see, our break even dropped again. So now our break even dropped to 420.54. Our max profit is actually also potentially more, but now your max loss is increasing again. Okay, so you need to be aware of that, right? But ultimately, again, what we did here is we have our call that we bought. We're down 20, 30, 40% on it. We sell a call to close it, and then we sell another call, same strike, and then we buy a call with a lower strike where we're still able to potentially make a profit. And if you set it up correctly, your break even will go down, and again, your max loss will also drop here. So this is a potential way to save a call that you're down on, because not only will you lose less if things do go wrong, but if things go right and the stock goes up, it doesn't have to go up as high now, only to 420.50 here versus again 429.04. Okay, so again, remember that before you enter any of these trades, please make sure you know how to close them. There's 4 different trades going on here, so it might get overwhelming if you don't know how to close these options. But again, I'll pin a video in the comments section below where I show you guys how to do that. So if you guys have any questions, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.